Beneath the surface of global financial markets, in data centers scattered across the planet, an invisible engine is running that most investors never see and most observers barely understand. This is the hidden infrastructure of artificial intelligence that powers trading, manages risk, detects fraud, and executes transactions for virtually every major financial institution on Earth. Understanding this infrastructure is essential because it represents the physical and computational foundation upon which trillions of dollars flow through global markets every single day. The specialized AI trading platform market was valued at approximately $11 to $13 billion in 2024 and grew to an estimated $13 to $15 billion in 2025, with forecasts projecting expansion to between $33 billion and $70 billion by 2030, reflecting a compound annual growth rate of roughly 20%. The global AI trading platform market size accounted for $11.26 billion in 2024 and is expected to increase from $13.52 billion in 2025 to approximately $69.95 billion by 2034, expanding at a compound annual growth rate of 20.04% from 2025 to 2034. But these market numbers tell only part of the story. The infrastructure supporting this market is vastly larger and more consequential than the software platforms themselves. In the second quarter of 2025, Taiwan's artificial intelligence-related exports to the United States reached roughly 14% of its gross domestic product, reflecting its central position in the production of high-end artificial intelligence chips through firms such as TSMC. When a single nation's AI-related exports represent 14% of its entire economy, that economy has become fundamentally dependent on AI infrastructure production. Physical infrastructure as competitive advantage, the most consequential aspect of AI infrastructure is data center build-out. If recent history holds, analyst estimates for technology capital expenditure may be revised higher still, with the hyperscalers having spent $106 billion in capital expenditure in the third quarter of 2025 alone, representing a year-over-year growth rate of 75%. This scale of capital deployment is staggering. Individual tech companies are spending more on data center infrastructure quarterly than entire nations spend on their annual defense budgets. The consensus estimate for 2025 capital expenditure by artificial intelligence hyperscalers is climbing, with analyst estimates having consistently underestimated capital expenditure spending related to artificial intelligence, with the divergence in performance showing that investors are not willing to reward all artificial intelligence big spenders the same. As investors have rotated away from artificial intelligence infrastructure companies where growth in operating earnings is under pressure and capital expenditure spending is debt funded, the physical infrastructure requirements are extraordinary. From data centers powering artificial intelligence to pipelines driving energy security and railroads transforming transportation, infrastructure is proving to be one of the most durable and exciting asset classes in capital markets today. There is 67 billion cubic feet a day of natural gas pipeline infrastructure being built today, with that infrastructure coming online between this year and 2027, representing about 3 times the amount of natural gas pipeline infrastructure that was built between 2022 and 2024. Where everything depends, the greatest vulnerability in global financial infrastructure is semiconductor supply. A data center filled with NVIDIA H100s in 2024 faces severe competitive disadvantages against one with Blackwell chips in 2025 and potential obsolescence with the next architecture, meaning that the effective economic life of GPU and ASIC chips is approximately 1 year. This creates a brutal dynamic where financial institutions must continuously upgrade infrastructure or face obsolescence. Depreciation schedules are too long, collateral values in default are illusory, and cash flow assumptions are fragile, with data center operators and financiers believing they are financing long-lived infrastructure assets comparable to commercial real estate or utility-grade equipment. But the effective economic life of GPU chips is approximately 1 year, automating trillions beyond high-frequency trading systems. Artificial intelligence is revolutionizing the infrastructure that clears and settles trades. In the realms of global securities trading and market infrastructure, artificial intelligence will play a significant role as firms rely more heavily on algorithms for high-frequency trading, with systems that track and instantly process disparate data sets required for real-time trading helping traders anticipate market trends and make transaction decisions more accurately. Artificial intelligence's predictive models and analytics will strengthen market surveillance and compliance monitoring, given the technology's ability to detect anomalies and potential fraud, with the automation of trade execution activities such as settlement and regulatory reporting helping reduce manual errors and operational costs. The Depository Trust and Clearing Corporation and the industry continue shifting from reactive to predictive responses, which in turn improves resiliency. Financial market infrastructures, including derivatives exchanges, clearing houses, financial market infrastructures, and trade repositories, are using artificial intelligence predominantly in transaction processing and automation, including the use of artificial intelligence for pre-trade and post-trade process automation, with machine learning being used to optimize trade settlement and predict the likelihood of trade settlement failure, pre-trade to post-trade. Certain market participants, particularly institutional investors, have developed artificial intelligence systems that are integrated with exchange platforms, with these systems capable of processing trade data in real time and extracting relevant information using natural language processing tools to automate trade processes such as order and trade validating and generating trade reports that can be submitted to regulatory authorities. This represents a complete transformation of market infrastructure. What previously required armies of back office workers manually processing trade details now happens through artificial intelligence systems processing millions of trades per second. Building infrastructure on debt, the most troubling aspect of AI infrastructure build-out is how it is being financed. During the early part of the current cycle, hyperscalers funded most of the capital expenditure from their own cash flow, which created a natural rate limit on growth and on the resulting system risk. But that changed in 2025 as data center spending soared, absorbing an ever larger share of earnings. Meta and Oracle issued $75 billion in bonds and loans in September and October 2025 alone to fund artificial intelligence data center buildouts, an amount that reflects the extraordinary capital requirements of artificial intelligence infrastructure. Hyperscalers can now push liabilities outward onto special purpose vehicles, infrastructure funds, private credit, insurance company balance sheets, and even indirectly into data center real estate income trust exchange traded funds, with the off-balance sheet financing structures being deployed containing a fundamental and dangerous expectation mismatch. Too interconnected to fail, the concentration of financial infrastructure in a small number of technology companies creates systemic risk that regulators are only beginning to understand. The financial architecture surrounding artificial intelligence has become oversized, overleveraged, and too dependent on a small set of interconnected actors, with risk increasingly migrating away from tech company balance sheets and into institutions, utilities, insurers, data center operators, private credit funds, pensions, and retail vehicles that do not see themselves as betting on GPU cycles, a potential future market with widespread use of autonomous artificial intelligence. Base trading might be more informationally efficient than a market shaped by human traders, but it could also be less resilient to shocks, with increasingly correlated positioning and strategies capable of exacerbating the impact of fire, sales in response to a stress event where firms could be forced to unwind leverage positions. Still essential, despite automation advances, human oversight remains critical. Many market observers and academics have been envisioning scenarios involving autonomous artificial intelligence that generates and executes trades without human oversight, but market participants are not at all comfortable with this idea yet, with most participants viewing having human oversight as an essential part of any artificial intelligence-based strategy for regulatory, risk management, liability, and ethical reasons. The latest Bank and Financial Conduct Authority survey on artificial intelligence in United Kingdom financial services shows 5% of respondents' artificial intelligence use cases have some form of autonomous decision making. Although currently only 2% are described as fully autonomous, the hidden infrastructure of artificial intelligence that powers global financial markets is one of the most consequential technological developments of our generation. It is simultaneously creating unprecedented efficiency and concentrating risk in ways that regulators are only beginning to understand. The institutions that built this infrastructure first are gaining competitive advantages that will compound over decades. The nations that control semiconductor production have become strategically essential to global finance.
Hmm.
The financial stability of the entire global system now depends on the continued functioning of infrastructure that most investors have never seen and most regulators are still struggling to understand.